Think about this for a second. We've all seen it. You're scrolling through social media and you see people your age living lives that seem impossible. Exotic vacations, luxury cars, and downtown apartments that cost more than your entire annual salary. Meanwhile, you're at the grocery store, staring at the price of eggs and wondering if you should switch to the generic cereal just to make rent. Here's the truth that most people miss. The gap between the financially secure and the financially stressed, it usually has nothing to do with how much money you make. I know people earning six figures who are completely broke, and I know people on modest salaries who are quietly becoming millionaires. The difference isn't the paycheck, it's asset ownership. We're living in 2026. Look around. The cost of everything has exploded. Housing, gas, groceries, it's all through the roof. Now, if you're playing it safe by keeping your money in a traditional savings account, you might be getting, 0.5% interest if you're lucky? That isn't saving. That's a trap. Because while your bank balance stays the same, its purchasing power is evaporating every single day. Your money is literally losing its value while you sleep. To thrive in this economy, you need a radical mindset shift. You have to stop viewing money as something to be saved and start viewing it as a tool to be employed. Think of every dollar you own as a tiny employee. In a savings account, those employees are just sitting in the break room, doing nothing. But when you invest, you're putting those employees to work 24/7 to build a future where you don't have to work harder because your money is finally working harder than you do. Picture this. It's 2 a.m. and you're scrolling through social media. You see someone your age posting from a beach in Bali or showing off a brand new Tesla. Meanwhile, you're sitting there calculating if you can afford the name brand cereal this week. We've all been there, wondering how the gap between barely scraping by and building real wealth actually gets bridged. Most people assume the stock market is a high-stakes casino reserved for Wall Street wolves in expensive suits. But the truth is, the stock market is the most accessible wealth-building tool available to regular people like you and me. The biggest hurdle for most beginners is a fundamental misunderstanding of what they are actually doing. There is a sharp, definitive line between speculating and investing. Speculation is essentially gambling. It's buying a stock because of social media hype, a hot tip from a cousin, or a trending meme. You're just betting that a lottery ticket will go up in price so you can sell it to someone else. True investing, however, is about ownership. When you buy a share of a company like Apple, Microsoft, or Coca-Cola, you aren't just buying a ticker symbol on a screen. You are buying a tangible slice of a real business. You are essentially hiring the smartest engineers and most capable executives on the planet to work for you. You benefit from their global infrastructure, their billion-dollar research budgets, and their daily profits. In 2026, this matters more than ever. The cost of living, housing, groceries, and insurance has exploded. If your money is sitting in a traditional savings account earning a fraction of a percent, it is literally losing purchasing power every single day. It's like watching your wealth slowly evaporate. Meanwhile, the S&P 500, which tracks the 500 largest companies in America, has historically delivered average annual returns of 8 to 10% over the long term. To put that in perspective, if a 25-year-old invests just $300 a month into a basic index fund, they could see that grow to over $800,000 by age 65. That is the power of compound interest. If you're worried about market crashes, remember this. Every major downturn in history, from the 2008 financial crisis to the 2020 pandemic, has been followed by a recovery to new record highs. The key isn't timing the market perfectly, it's time in the market. For those who don't want to spend hours analyzing individual companies, the free lunch of the investing world is the index fund. It's like buying a pre-made fruit salad instead of picking every piece of fruit yourself. With one purchase, you get instant diversification across hundreds of successful businesses. Starting today in 2026 is easier than ever. You can open a brokerage account from your phone in minutes.
You don't even need enough money for a full share. With fractional shares, you can invest $50 into a company that costs $3,000 per share. The strategy is simple. Open an account, automate your contributions, choose low-cost index funds, and then do the hardest part of all: nothing. Let time and the global economy do the heavy lifting for you. Your future self will thank you for getting off the sidelines.
Have you ever looked at the stock market and wondered, why does this actually work? Most people see a screen of flickering red and green numbers and think it's just a digital casino driven by luck. But if you want to build real wealth, you have to look past the flashing lights. Behind every ticker symbol is a living, breathing engine of growth. Let's pull back the curtain on the mechanics of market growth. Stocks don't go up because of mystical forces or internet hype. Over the long run, stock prices follow one thing: earnings. Think of it this way: if a company consistently grows its revenue, that's the total money coming in, and it successfully protects its profit margins, the money left over after the bills are paid, that business becomes more valuable. It's simple math. When you buy a stock, you aren't gambling on a number, you're buying a claim on those future profits. But how do these companies keep making money year after year? Why don't competitors just swoop in and steal their customers? This is where the concept of the economic moat comes in. Think of a medieval castle. The bigger the moat, the harder it is for an enemy to attack. In the business world, a moat is a competitive advantage. Take a company like Apple. Their moat isn't just a phone, it's an entire ecosystem. Once you have the watch, the laptop, and the cloud storage, it becomes incredibly inconvenient to leave. This ecosystem creates a barrier that protects their profits. When you invest in companies with deep moats, you're essentially hiring a fortress to guard your wealth. Now, let's address the elephant in the room: risk. I know what you're thinking. What about the crashes? What about 2008 or the pandemic of 2020? Here is the truth that will change how you sleep at night. While market crashes are terrifying in the moment, they have a 100% recovery rate in the history of the US market. Every single major downturn has eventually been followed by a recovery that pushed the market to new all-time highs. The risk isn't that the market will go to zero. The risk is that you'll get scared and sell at the bottom. Historical resilience proves that the market is a wealth escalator that occasionally pauses or dips, but the long-term direction has always been up. If you're waiting for the perfect time to start, remember this: the best time to plant an oak tree was 20 years ago. The second best time is today. You don't need to be a genius to master these mechanics. You just need the discipline to stay invested while the engine does the work for you. Stop watching from the sidelines and start building your own fortress. In the high-stakes world of investing, there's a concept often referred to as the only free lunch in finance: diversification. For most of us, the goal isn't to spend 40 hours a week squinting at complex balance sheets or tracking the minute-by-minute fluctuations of a single company's stock. We want our money to work for us, not the other way around. This is where the index fund emerges as the ultimate solution for the modern investor. To understand why this works, let's use the fruit salad analogy. Imagine you walk into a market and spend all your money on a single, giant peach. You've done your research, it looks ripe, and you're hungry. But when you get home and take a bite, you realize it's rotten to the core. Now you have nothing to eat and your money is gone. That is the inherent risk of buying an individual stock. No matter how much you like a company, unforeseen disasters, a CEO scandal, a supply chain collapse, or a shift in consumer taste can sour your entire investment overnight. Now, compare that to an index fund, which is like a giant pre-made fruit salad. When you buy a fund that tracks the S&P 500, you aren't betting on one fruit. You are gaining instant exposure to 500 of the largest, most successful companies in the United States. If one company in that salad goes bad, it barely affects the flavor of the whole bowl. The other 499 companies are there to balance it out. By diversifying, you significantly lower your risk while still participating in the long-term growth of the entire economy.
However, the magic of index funds isn't just about safety, it's about efficiency. One of the most critical lessons in building wealth is understanding that fees matter. In fact, fees are one of the greatest wealth killers in existence. For decades, the financial industry was dominated by actively managed funds. These are run by professional stock pickers who try to beat the market. Because they have high overhead and expensive salaries, they often charge fees of 1% to 2% annually. While 1% might sound small, the math of compounding works against you here. Over a 30-year career, that 1% fee can end up costing you hundreds of thousands of dollars in lost gains because that money isn't staying in your account to grow. Modern index funds, on the other hand, are passively managed. They simply follow the index. Because there's no need for an army of analysts, these funds often charge less than 0.1%. By choosing an index fund, you are effectively cutting out the middleman. You stop paying for someone else's yacht and start keeping almost all of your gains for yourself. In the end, successful investing isn't about being the smartest person in the room or finding the next hidden gem before anyone else. It's about being disciplined, keeping your costs low, and owning the whole fruit salad. Index funds allow you to capture the growth of the global economy with minimal effort and maximum efficiency. It is the simplest, most effective way to ensure that your financial future remains ripe with opportunity.
If you've been waiting for a sign to start investing, this is it. In 2026, the traditional barriers to entry haven't just been lowered, they've been demolished. You don't need a three-piece suit, a finance degree, or a massive bankroll to get started. Honestly, you can build a multi-million-dollar portfolio right from your couch using nothing but your phone. But starting is a vague term. Let's get tactical. Here is exactly how you execute the transition from a saver to an investor. First, we need to talk about where your money lives. If you want the ultimate hack for long-term wealth, look no further than the Roth IRA. Think of the Roth IRA as a lifetime pass from the government. In 2026, the contribution limit has moved up to $7,500 a year. Now here is why this matters. Unlike a standard brokerage account, the money you put into a Roth has already been taxed. This means every dollar of growth and every cent of profit is yours to keep. When you hit retirement age, you can withdraw that entire fortune completely tax-free. It is, quite literally, the most powerful tool the average person has to protect their future wealth from the IRS. The biggest mistake new investors make is trying to time the market. They wait for a crash to buy, or they panic when prices dip. Professionals don't do that, and neither should you. Instead, use dollar-cost averaging. This is the practice of investing a fixed amount, let's say $300 every single month, regardless of whether the market is up, down, or sideways. When the market is down, your $300 buys more shares. When the market is up, your $300 buys fewer shares. Over 10, 20, or 30 years, this math works heavily in your favor. It averages out your cost basis, and more importantly, it removes the emotional element of investing. You aren't gambling, you're automating your success. Finally, let's kill the myth that you need thousands of dollars to buy big stocks. In the past, if a dominant tech company's stock was trading at $3,000 a share, you were locked out unless you had that full $3,000. Not anymore. Thanks to fractional shares, high price tags are no longer a barrier. If you have $50, you can own $50 worth of that $3,000 company. This allows you to diversify immediately. You can own a piece of the world's most successful corporations for the price of a dinner out. The bottom line? Wealth isn't built by hitting a home run on a single trade. It's built through the tactical use of tax-advantaged accounts, the discipline of consistent monthly contributions, and the accessibility of modern trading tools. The system is ready for you. The only question left is, when do you click buy? Most people believe that successful investing is a battle of spreadsheets, complex algorithms, and advanced mathematics. They spend hours analyzing price-to-earnings ratios and scouring quarterly reports. But the reality is far simpler and much more difficult. The hardest part of investing isn't the math, it's the discipline. The market doesn't just move numbers, it moves emotions. To succeed, you have to win the psychological game. Human nature is hardwired to seek safety in rising prices and feel fear when things plummet. When the stock market climbing the wall of worry turns into a downward slide, the average investor feels a sense of loss. But Nick Magielli argues that for those in the wealth accumulation phase, this is a fundamental misunderstanding of reality. Think about your behavior outside of the stock market. If your favorite brand of coffee or a high-end television goes on sale at the grocery store, you don't panic. You don't run out of the store crying that your assets have lost value. Instead, you stock up. You recognize that you are getting more value for every dollar spent. If you are a long-term buyer, someone who plans to contribute to their portfolio for the next 10, 20, or 30 years, lower prices are your best friend. A market crash is simply the world's greatest department store holding a clearance sale. Every share you buy during a downturn has a higher expected return than the shares you bought at the peak. When you shift your mindset from losing money to buying at a discount, you gain a psychological superpower that keeps you in the game while others are folding. In a world of instant gratification, investing is the ultimate test of delayed rewards. We live in an era of one-click ordering and instant streaming, but wealth creation still follows the laws of biology, not technology. Consider the oak tree philosophy. When you plant an acorn, you don't return the next morning expecting to sit in its shade. You understand that the transformation from a tiny seed to a towering, sturdy tree takes decades of quiet, invisible growth. The biggest mistake investors make is digging up the seed to check the roots. Every time you panic sell during a dip or jump from one hot fund to another, you're essentially uprooting your progress. You reset the clock on compounding. It requires the patience to let your seed grow for 30 years without constant interference. The oak tree doesn't grow faster because you stare at it, and your portfolio won't grow faster because you check the balance every hour. By adopting the oak tree philosophy, you acknowledge that your job isn't to force the growth. Your job is to provide the environment, the consistent contributions, and the time, and then get out of the way. In the end, your investor IQ matters far less than your investor temperament. If you can stay calm when the headlines are screaming and stay patient when the progress feels slow, you have already won the psychological game.